I'll be going through how to trade options in the UK to maximize your profits. This is a beginner's guide to options trading in the UK. Hi, this is Mosh. I'm an amateur trader and investor. Anything I learn, I teach you guys. I have recently started options trading to up my trading game. By the end of this video, you will understand everything that is going on this page. And as you can see, my first options contract, I managed to make $157 from $385. That's roughly a return on investment of 40%. So options are a really great way of making money. But the problem we have in the UK is there's not many providers for it. So let's start off with what an option actually is. An option is a contract that gives the buyer the right but not the obligation to buy or sell 100 shares worth of stock at an agreed price and time. You might have heard people say in the money, out the money, call options, put options. I'm going to explain everything that you need to know about options today. Options can be very confusing, so the best way is with lots of examples. I'm going to use the Apple stock options to explain everything that I'm doing, break down every key part that you need to know on this screen that you see. The first thing that you need to know, as you can see, there's two types of options. There's calls and there's also puts. You can also see the bid price, the ask price for calls, and bid price and ask price for puts. Bid price means the highest price the buyer is willing to pay. Ask price is the lowest price a seller will accept. The last traded price will be somewhere in between those two values. And the difference between them is called the spread. So if we just stick to the ask price, we can say that these are your option prices. Call option prices increase when the stock price increases. The next key thing, if we look along here, is the expiry date. All options have an expiry date. This particular option expires 22nd October 2021 at 8 PM GMT, so in 40 days. If we go further down, you can see the dates increase. So this expiring 29th October 2021, 8 PM GMT. So that is the expiry date. Now the line that's going in between, the dashed line, is the stock's current price, and the stock's current price is also up here. It's $148.97, and this is for the Apple stock. The values that you see here, where it goes 146, 147, 148, 149, 50 and 155, this is what you call the strike price. Now with call options, the option price increases as the stock price increases. So if you're bullish on Apple, you'd buy an Apple call option. On the other side, where we have the puts, what it shows here are the put option prices, and they increase as the stock price decreases. If you're bullish on Apple, you would buy put options. Call options give the buyer the right but not the obligation to buy 100 shares worth of that stock. Put options give the buyer the right to sell 100 shares worth of the stock. As this is a beginner's guide, I'm not going to talk about shorting call options and put options because that is very high risk. It does get fairly complicated. I'll do another video on shorting options sometime in the future. Before we start really analyzing all this information and options, there's a couple of key terminologies that you guys need to understand. The first is something we call intrinsic value. Let's say I bought a call option for a house. Remember, a call option is just a contract. Let's say this option strike price was $100,000 and expiring in 1 year's time. So what that means is that contract allows me to buy that house from today's date up to 1 year's time for $100,000. Now let's say after 6 months that house price goes to $150,000. That means my contract has a value of $50,000 because that contract gives me the right to buy the house at $100,000 from any point from now to a year's time. In 6 months' time is $150,000. The value of the house has increased $50,000. That is what we call intrinsic value. I'm going to break down intrinsic value and how we work it out in terms of the Apple options. So if we stick to the 22nd October contract and I go to this strike price of $146, the current stock price is $148.97. To find the intrinsic value on call options, it's always the stock price minus the strike price. So what this $146 means is that I have the right but not the obligation to buy 100 shares worth of stock at $146 with an expiry date of 22nd of October. And it's also a term we call in the money. That I'll talk about and explain later on, so make sure you keep watching till the end. Apple's stock price is worth $148.97. My strike price is $146. So that gives me an intrinsic value of $2.97 because it's the stock price minus the strike price. That is for one contract. Now remember, one contract is worth 100 shares. So that intrinsic value, that $2.97, we have to times by 100. So that gives me a total intrinsic value of $297. Now you're probably sitting there thinking, surely that's too easy. You've just made $297 by clicking a button. However, options have a premium. That premium is the price of the option. So if we go on the ask, we can see it's $7.25. That is the option premium. Now, if I click this, you can see a bit more detail comes up. Now, remember, one option is worth 100 shares. That premium of $7.25, we have to times by 100. So it gives us a total premium, as you can see here, as $725. So we had intrinsic value of $297, but we had to pay $725 as a premium. So that leads us in a loss of $428. Now to work out put options intrinsic value, it's a strike price minus the stock price. So for example, if I go to the strike price of $150, we know the Apple stock is at 148.97. So the strike price is 150 minus the stock price 148.97. That gives us an intrinsic value of $1.03. Now remember, an option is for 100 shares. So what we have to do is times that by 100 to give us $103. And as you can see, the ask price of this option is 5.95. Now we have to times that by 100. That gives us a premium of $595. So intrinsic value of $103 and a premium of $595. So that would give us a loss of minus $492. Now you might be thinking, well, you're just losing money. However, there is more to options. We're going to get onto that. But before we do, we need to understand what extrinsic value means. Extrinsic value means a potential for the option to become more valuable before its expiration date. Extrinsic value is really what we call time value. The longer time the expiration, the more chance of the price going either up or down. And options with more time trade with more extrinsic value. And I'm going to show you an example exactly what I mean. So we have option contracts that expire 22nd October in 40 days. And we also have options that expire 29th August in 47 days. If we look at the 22nd October with a strike price of $149, and you can see the option price is $5.50. Now, if we look at the contract that has more extrinsic value or more time value because later on in time, it's an extra 7 days later, for the same strike price at $149, the option price is $6.80. Also be aware, an option can have extrinsic value with no intrinsic value. So for example, if we go back to the $149 strike price and our stock price is $148.97. So the stock price is $148.97, strike price of $149. That difference there gives us $0.03 of intrinsic value, basically $0. But the value comes from the expiration because it's expiring in 40 days. So in 40 days time, it's highly unlikely Apple stock price will remain on $148.97. Now, the key benefit of options is the maximum you could ever lose is the premium. So if I was to buy this option with a strike price of $149 expiring on the 22nd of October 2021, and I click on the details, you can see the premium is $550. It's not like leverage trading or CFD trading where you get a margin call and you can completely blow up your account. That is your maximum loss. You can't lose any more than $550. This is why many people use options to manage the risk, to hedge. Remember what we said at the start. An option gives the buyer the right to buy or sell 100 shares worth of stock, but not the obligation. So what if you want to exercise your option? What if you want those 100 shares worth of stock? So for example, if the stock price of Apple is $148.97, I can buy this option that sits at $146. If I exercise it, that means I'm buying 100 shares of Apple at $146. But options are very rarely exercised because the profit is already baked into the option price. So if the stock moves up, your option becomes more valuable if you bought a call option. If the stock moves down and you bought a put option, your option becomes more valuable and the profit is already embedded into the option price. So you'll never need to exercise your option unless you really want to buy 100 shares worth of that stock at that current price. But sometimes it's not worth it, and I'll show you an example. Let's say I bought this option with a strike price of $148 expiring 22nd of October. The option price is $6.10. So that means the premium is going to be $610 because we always times it by 100. Now, if I want to exercise this option before the expiry date, what that means is to buy 100 shares, I would need $148 times 100 shares gives us $14,800 in my account. Not only that, I've paid $610 as a premium. So that gives my total to $15,410. Now, as it's getting closer to expiry, it's losing its extrinsic value as well. So to work out how much we paid per share with the premium included, all we have to do is take our $15,410. So that's the 100 shares at $148 plus the premium of $610 divided by 100 shares. That gives $154 per share. So you can see why people don't exercise options. Now, if you're not interested in options and this has gone way above your head, don't forget you can get free shares worth up to £100 if you open up an account with Trading212 or Free Trade. Use my link below, deposit £1 and you get your free share. The next thing we need to talk about is the Greeks when it comes to options trading. I'm only going to talk about one, and the one I'm going to talk about is the one that's represented on my screen called Delta. Delta estimates how much a stock price will change for every $1 movement in the stock price. Call options have positive deltas. So what that means is the options price increases as the stock price increases, and the option price falls as the stock price decreases. And you can see all these values are positive. For put options, the delta is negative. So what that means is the options price increase as the stock price decreases. And as the stock price increases, the options price decreases. So let's do an example. So I'm going to choose the strike price of $147. The stock price is $148.97. The call option price is $6.65 and the options delta we have as 0.58. So let's say the Apple stock price increased by $1. So the stock price now will be $149.97. What that means is the new option price will be $7.23 because what we've done is this 6.65, we've added 0.58 because the stock has moved by $1. Now, if the stock decreases by $1 to $147.97, so the stock price is decreased by $1, then that option price will now be $6.07 because we've minus the delta from the options price. One thing to be aware, the delta always changes because the market's always changing. Options can be very, very confusing, but just be aware, as long as you're not shorting, the maximum you can lose is your premium. So it's a good way to manage your risk and good way to make steady profits. I will do another video on the rest of the Greeks that you need to know about. But as I said, today's just a beginner's guide. I'm going to open up my initial first ever trade of options, which was a neo call option. One thing to be aware of is if you're in the UK and you're dealing dollars, there's an exchange fee that you need to take into account. And the commission Saxo Bank takes is relatively small. It's usually around $3 per contract that you buy. So as you can see, I've lost, due to the fees and everything else, £10 in that trade. And I find it a lot cheaper than CFD trading. I'll appreciate a like and a sub on this video as well.